let's kickstart the show with some commentary coming in then. Speaking at the Washington Forum, Fed Chair Jerome Powell spoke about how they plan to tackle inflationary pressure going forward. He also signaled that rate cuts might be delayed. Further, listen into what else he had to say as well.
By many measures, our labor market has been moving into better balance over the past year. The ratio of job openings to unemployed workers was extremely elevated in 2021 and 22, has now moved back down to levels just above the pre-pandemic era. Surveys of workers and businesses indicate a normalizing labor market. So do the rates of both quits and hires. Broader wage pressures also continue to moderate, albeit gradually. So the overall picture for the labor market is one of real strength, but gradual normalization. Given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%. For one thing, we try to be very transparent and predictable given the flow of data and events. I mean, you have to move quickly sometimes, but we do realize we have a special obligation to be predictable and transparent, and that benefits us in doing that as well. Inflation, of course, declined quite significantly over the second half of last year, over the whole year, but particularly in the second half. But 12-month core PCE inflation, which is one of the most important things we look at, is estimated to have been little changed in March over February at 2.8%, and the 3- and 6-month measures of inflation are actually above that level. So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. You know, we took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed. At the same time, we have significant space to ease should the labor market unexpectedly weaken.
Well, that's the commentary coming in from Fed Chair Jerome Powell. He says that the Fed is not going to cut rates as soon as expected, but well, we can assume and we can understand that the Fed is in the position to take care of all the struggle that they've been seeing in inflation. The policy is in place. So, well, that was the word coming in from Jerome Powell. But let's keep it with commentary coming in from FOMC and from the Fed members, because Cleveland Federal Bank President Loretta Mester, as she says that the monetary policy is in a good place and the central bank should not hurry to cut rates. Although she still expects inflation will fall further, she also said that she wants to see more data to gain confidence that inflation is moving towards that Fed's 2% target as well. And if you remember last week when Mary Daly spoke about this, she also had a similar stance on this, and other FOMC members have also been maintaining their stance on this. So interesting to see what's playing out on that front, Shansi.
Absolutely, and what's also interesting separately is tech giant Google, because they're conducting a large-scale layoff impacting an unspecified number of employees in its real estate and finance departments. The restructuring involves expanding growth to cities like Bangalore, Mexico City and Dublin. This comes amid Google's latest restructuring and cost-cutting plans. On the other hand, Tesla will be laying off around 285 employees in Buffalo, New York, as part of its plans to trim 10% of its global workforce. The notice was issued under the Worker Adjustment and Retraining Notification Act, which requires employers to provide a 60-day notice before layoffs.
Well, and another big news then, U.S. President Joe Biden has called for tripling the China tariff rate on steel and aluminum imports as he makes the rounds in the key battleground state of Pennsylvania. Biden's demand to raise the current 7.5% average tariff is an effort to make clear that his administration's recent warnings about China's trade practices are not just empty threats.
And shifting focus from US to UK then, as inflation in the country falls to its lowest level in 2.5 years in March, although the consumer prices rose by 3.2% in the year to March, down from 3.4% on a month-on-month basis. The fall in the annual rate was not as big as anticipated, although inflation is still running higher than the Bank of England's target of 2%, economists say that the direction of the move appears to be clear at this point.
If you like this video, then like, share and subscribe to ET Now.